Now today we will be discussing a very important concept of corporate finance, that is WACC. WACC is weighted average cost of capital. Now the role of the finance manager is to raise finance through an appropriate blend of debt and equity, which is known as the financing decision, and to use the funds to invest in suitable projects, the investment decision. That is, the goal of the financial manager is to increase shareholder value. Right? We must have discussed this, and you must have studied this in the agency, conflict of agency and agency cost. In agency cost and conflict of interest of different stakeholders. Now, it is generally accepted that discounted cash flow techniques for evaluating projects are far superior to use of simple payback projects of accounting rate of return, that is ARR. The shareholder value added approach enhances these techniques further. However, to use these techniques, we have to calculate the cost of capital. In the absence of a suitable discount rate, NPV and IRR approaches have no meaning. So, in the capital budgeting, what we were using these two techniques mainly, NPV and IRR, and others as well, like the profitability index and etc. But since when there is no cost of capital, then what's the use of these two? We cannot calculate these two measures. So what we can do then, provided that the project achieves the expected return and that when adjusted for the risk of that project, the return is in excess of the company's WACC, the shareholders are better off than before. So if the return is greater than the WACC, then only we can say that the shareholders are getting their desired return on the value. So how can we achieve that? Okay, so first of all we will be doing what? We will be defining WACC. That what is WACC? Weighted average cost of capital. It is basically just an average of the two. It is just an average of the two terms that. So it is just an average of the two terms, that is debt and equity mainly. It can be written as market value of debt, right, divided by simple market value of both debt and equity, debt plus equity, multiply by, since the market value of debt is on the upper side on the numerator, so we will be multiplying it with net cost of debt and adding market value of equity upon the total of both market value of debt plus equity into cost of equity, So I hope that this is the main formula which you guys will be considering. Now if you remember, what is cost of equity? It is the total return that is expected by individuals when they invest in the shares, and it is not just the dividend yield, right? So return to shareholders is what? Return of shareholders is in two forms. If you can recall, yes, one is the dividend they receive and the second is capital appreciation, basic initial concepts of corporate finance. So it is in the form of dividends and it is in the form of capital appreciation. Capital appreciation is when, for example, if I have invested in Apple, or if I have invested in any stock and if it costs like $10 and if its price have increased to $12, the $2 difference that has been made is the capital appreciation. And for example, if the company gave for example $1 dividend, 10% dividend yield, it will be very high. But for example, if the company is giving us a $1 dividend as well, so my total return would be 1 plus 2, that is $3 return. So return of shareholders is not only dividend but it is also capital appreciation. Okay, now if we recall, what was gearing? If I say the company is geared up, what it means? It means it was what? Book value of debt divided by the book value of debt plus equity. So please guys be careful, we are talking about WACC, and in WACC we have what? The market value, not the book value. So gearing was more like in accounting terms we were considering the book value of the terms, right? It was either this or it was another formula was what? Book value of debt divided by simple book value of equity. Now if we look at the cost of debt and cost of equity. So cost of debt and cost of equity. These are the two terms that are in the formula of WACC. If you have recalled that net cost of debt and cost of equity. So basically what is net cost of debt? Net cost of debt can be simply expressed as gross cost of debt into 1 minus T, of course. So gross cost of debt into 1 minus T. Right? So it is simply net cost of debt is equals to gross cost of debt into 1 minus T, that is net of tax. Interest payments on debt finances are tax deductible. They appear before the tax line on the income statement. My dog actually is continuously barking. So okay, now what is the fundamental concept that you should be familiar with? The fundamental is that cost of equity, right? Cost of equity should be greater than cost of debt. And why is that? Why? Because there is a more favorable treatment, more favorable tax treatment. This is favorable tax treatment of debt. This had led to considerable debate over determining the correct cost of capital to use, because the weighted WACC will be very sensitive to the ratio of debt to equity on a company's balance sheet. So this should be taken into consideration, and this has been tested in different types of exams as well, in the ACCA and the other exams. Okay, for example, if I say Naeem PLC, right, has a debt of with a market value of, for example, 100 million. This is debt. Trading at a GRY, that is gross redemption yield of 10% in the market, and has $100 million equity. Analyze and suggest what would be the condition if the equity investors are expecting a 12% per annum return from their investment, and the WACC, assuming no tax is paid, could be set to 11%. So WACC is like 11%. And what is the return, or the cost of equity? The cost of equity is given to us, it is 12%. So it is simply that if the company, now if I analyze this company, what will be my final verdict on this? It will be that, for example, if the company has GRY, this gross redemption yield of 10%, it means what? It can pay off its lenders at 10%. Right? A return of 10% to its lenders. It is providing a return of 12% to its equity providers. So what is WACC? WACC is coming 11%. So basically it is what? It is just an average of the two, because we haven't taken into consideration the tax. So it means that the WACC calculation is correct over here. WACC is correct. Now this is the first part of WACC that has been completed. This is the end of this session.